This is the Do-It-Yourself Guide to Business Buying. Today we're talking about finding the money. Welcome, business buyers. What is our goal with this video, finding the money? Well, we want to talk about how to raise money to buy a target business that you want to acquire. Let's jump right in. To me, there are 7 sources of funds that we can use to finance a deal. We can come up with an equity investment or find an asset-backed loan. Maybe we can arrange a cash flow loan. In the U.S., there's the SBA loan. Of course, we have a seller note or vendor financing as an option, and revenue financing is another option. Now, we have creative financing solutions as well. I'm not going to talk much about them in this video, but look forward to them in future upcoming videos. Let's take a look at a deal. We have a target co of $2 million that we want to buy. We arrange an equity investment. We find an asset-backed loan, and we source a cash flow loan. The rest is going to come from a seller note or vendor financing. The first 3 are where we get the closing payment. The seller note, of course, is payment over time. That's just one possible generic financing structure. Now, before I go any further, I want to throw out 3 reminders to keep in mind when we're financing a deal. I think it's important to have this as a backdrop as we go through this material. Number 1, the larger the equity investment, the easier it is to arrange debt financing. And of course, the more debt financing that we raise, the larger the closing payment that we can make. Why do we care about that? Because the larger the closing payment, the easier it's going to be to close a deal. So keep that in mind as we work through this material. When it comes to structuring the financing, it often changes deal to deal. If we have 6 sources of funds, equity investment down to revenue financing, we can take a look at financing in different ways. Here's one possible structure. Equity investment, we come up with a 5% equity investment. We find an asset-backed loan for 35%. Cash flow loan doesn't work in this deal. We're not pursuing an SBA loan. So the remaining 60% is going to come from a seller note because revenue financing doesn't fit this deal either. So in terms of structure 1, that's what it looks like. 5% equity, 35% asset-backed loan, and 60% seller note. So if we take a look at it graphically, we have a 5% equity investment, a 35% asset-backed loan, and a 60% seller note. So together we have a closing payment of 40%, and 40% of $1.6 million, we're talking about a $640,000 closing payment. The payment over time in the seller note is 60% or $960,000. So that's how structure 1 works. If we take a look at structure 2, we go down our list. Equity placement, not going to work this time, but we have found an asset-backed loan that we can use for 50% of the purchase price. Earnings aren't consistent enough to use a cash flow loan. We're not pursuing an SBA loan. So the other 50% is going to come from a seller note because revenue financing doesn't work in this deal either. So structure 2 looks like this: 50% asset-backed loan, 50% seller note. So if we've got a $1.6 million target code, this time the asset-backed loan is 50% and the seller note is 50%. So we have an $800,000 closing payment, and the payment over time is also $800,000. That's structure 2. Let's take a look at a third and last structure. This time equity doesn't work. There aren't any assets to borrow against. Cash flow is not consistent enough to get a cash flow loan. We aren't going down the SBA route. We're really left with the seller note. And so we propose an offer to buy the business using a 100% seller note because revenue financing, again, is not going to work. So we have a very simple structure this time. It's the same $1.6 million target co. We propose buying the entire thing using a seller note to finance 100% of the transaction. So the whole $1.6 million is going to be paid over time. The closing payment is 0. Now, can this kind of deal get done where we have a 0% closing payment? The simple answer is yes, it can be done. I've done it myself multiple times. I've worked with other people that have done it. You have to be selective. You have to pick your spot. It doesn't work in every deal. But if you have the right deal, the right circumstances, and the right seller, yes, you can put together these kinds of deals. We talk a lot more about it in our videos on screening, so I suggest you check those out if that's something you're interested in. When it comes to structuring, of course, there are other possibilities, but unless you plan to personally provide 100% of the acquisition financing, you're going to need to find lenders, potentially investors, to provide the acquisition financing, of course, including vendor financing. And that's what we're going to spend the rest of this module discussing. Now, lenders and investors are fundamentally looking at 3 things before making a lending or investing decision. Because success is based on future events, they look at the assumptions that are made surrounding the business plans that we're offering or the cash flow forecasts that we're making. Anytime we're forecasting future results, assumptions get made, sometimes big ones, sometimes small, sometimes there's a lot. But the big question is, are they credible, these assumptions? Will lenders and investors accept the assumptions that we're making? Really important. If they agree to most of them, we're in good shape. If they start rejecting them or questioning them, we could have problems. So it's important to take a look at the mix. Here's where we want to be. Most of the assumptions that we made, yeah, they're readily agreed to by lenders and investors. And the ones that they reject and the ones that they question, yeah, small in number. If we're in that situation, I think lenders and investors are going to find the deal credible and we're going to easily progress to the next phase. However, if the number of assumptions they start to question or outright reject climbs too much, we'll fall into the doubtful category and get a thumbs down. It could be worse. I've seen these kinds of deals where I reject almost all of the assumptions that were made. In fact, it comes across as almost downright fraudulent. In any case, it's going to be a hard no. So the credibility of assumptions, important. You need to pay attention to investor and lender perceptions when it comes to assumptions. It can be a make or break factor in your deal. Now, I said that investors and lenders look at three things in every deal. Credibility of assumptions is one of them. Hey, what are the other two? Well, it's upside potential and downside risk, but they're considered together. The relationship between them is what's important. I mean, upside potential does not have to be that high as long as the downside risk is low. After all, lenders have their upside capped, so they are laser focused on the downside part of the equation. But if you're an equity investor, the downside risk can be considerable as long as the upside potential is strong enough. I mean, investors and lenders are always evaluating, hey, how strong is the upside potential in this deal? Or how big is the downside risk? And you have to make it make sense for them. They have to fit together. You can't ask them to take on too much downside risk if the upside is limited and vice versa. So those are three things that can derail your deal that you want to keep an eye on. You want to avoid assumptions that lack credibility. You want to avoid an upside that is limited given the downside risks. And you want to avoid downside risks that are too high if you do have a limited upside. And I think you need to pay attention to all three. Okay, we have our funding sources. Now we want to take a look at steps for securing the funds. Number one, we have to find willing lenders or investors. When we do, we have to do some discovery on their funding criteria. Next, develop a strategy for reaching out to them. Yeah, of course we can do cold outreach, but getting a referral or an introduction definitely helps. Then we got to talk about pitching your deal. That's usually associated with equity, but the same principles apply with debt as well. And finally, provide the due diligence information that they're going to need as part of the underwriting or investment decision. So when it comes to arranging financing, we have funding sources and we have steps to secure funds, 6 funding sources, 5 steps. How do we match them up? Well, I figure that we have to match them up one at a time. For example, when it comes to equity investment, the steps are going to be slightly different for equity investment than asset-backed loans. So what I decided to do was to make a video for each one. So we have an equity funding video, an asset-backed loan video, there's a cash flow video we're developing, an SBA loan video, of course, a seller note video, and finally, a revenue financing video. This is a 6-video series, and that's where we're going to do the deep dive on the mechanics of raising money from different funding sources. In this video, we're going to take a look at common financing issues. I want to start with a question. What determines deal structure? I think we've already established that maximizing the closing payment gives us the best chance to close a deal. So let's take a look at an actual example. This is a $2 million target co that we want to buy. There's going to be a closing payment. There's going to be payment over time or a seller note. What's the seller preference? Sellers want as big a closing payment as they can get. They'd prefer all $2 million, but at least as close as possible to that $2 million. If they're writing the deal, that's the way they're going to write it up. Of course, the buyer preference, especially if they're doing leveraged buyouts, which is the focus of this video series, it's the exact opposite. They want to make the closing payment as small as possible and leverage the deal through a seller note. So let's look at some options. We have this $2 million target co. We look at the balance sheet and we ask, How much can we borrow against the assets of this business? We note that Target Co. does have fixed assets on the balance sheet, so we determine the fair market value of those assets, not the cost, not the book value, but the fair market value. And then we establish the loan to value ratio. What is that? That's the percentage of the fair market value that we can actually borrow against that particular asset. So that's going to give us an asset backed loan. In this case, it's 30%, which of course would translate into 30% of 2 million or 600K. That's our closing payment. The rest is seller note, 70% or $1.4 million. That's the payment over time. And we take that information and submit an offer. Closing payment 600, seller note 1.4. Seller response, closing payment is too low. I need $1 million closing payment for me to move forward. Okay, back to the drawing board. We figure a way to bring some equity investment into the deal. We come up with 100,000 of equity. That bumps our closing payment to 700K. It was 600K. Drops the seller note from 1.4 million down to 1.3. So we've got a new possible structure, and so we put it into a counteroffer. But the counteroffer gets rejected, still short of the $1 million closing payment that this particular seller is looking for. That's a hard minimum. So we go back a second time. We think, well, we've got equity. Maybe we can use that equity to help us float a cash flow loan. And so we successfully do that, which bumps the closing payment up to $1 million, the seller note down to $1 million. That's the payment over time. We submit another counter offer. This time the seller accepts. Bingo, we're in good shape. That's how we finance the deal. Note that the equity investment helped in two ways. Number one, it makes the cash flow loan possible, which it very often does, and increases the closing payment in its own right. So when you're putting together an equity package, it can really help if you have skin in the game. You've got your own money in the deal. You are financially committed, and or your friends and family are financially committed. Investors love that. It gives investors insurance against you walking away. Things get rough. They don't want you to decide you're going to spend the next year in Banff as a ski bum. They want you committed. They want your friends and family committed. It gives them insurance against you walking away from the deal, which is exactly where they want to be. So you having skin in the game also makes it easier to raise debt financing and easier to arrange a seller note. It's not always possible to put equity into these deals, but it really helps if we can do it. Next, can or should we use a financial intermediary, like a financial broker or a loan broker? Let's use the last example to review using an intermediary. You need to raise $1 million in a closing payment. The deal has fixed assets, so you take a look at asset-backed lenders as a potential source of funding. When you canvass the field, you realize there are quite a few of them out there. And so your job is to find a willing lender. You reach out, you need to make some connections, you need to establish some relationships. Of course, you need to learn their lending criteria, and you have to be able to provide financial information they need and answer their underwriting questions. So you've got your work cut out for you, but there's one hidden issue you'll face that's not obvious. Some lenders will restrict the use of proceeds, i.e., there are lenders out there who won't issue acquisition debt. So the pool of lenders is actually smaller than you thought it was, but it's not obvious on the surface which is which. So if you're new to deal making, the process can be challenging, especially if you're under time pressure. So you consider stepping back and engaging the services of a financial broker. Why? Because a financial broker will already know which lenders provide acquisition debt. They'll already have culled the field and have existing relationships with relevant lenders. Those are already in place. They understand their lending criteria. They know what financial information they're going to need to make an underwriting decision, and they can help answer their underwriting questions. So it can really work nicely using a financial broker when you're in a time crunch. However, there are two issues to be aware of. Number one, it can be a tad expensive. Now, I think that part is doable if the fee is mostly success-based, which with good brokers it is, and it's rolled into the balance owing. Shouldn't be a problem. The other issue can be more tricky, and that is there's a lot of fringe players in this space, financial broker. You can see dozens of them on LinkedIn. These folks charge up front for access to their lender list and offer very little in terms of value add. And so if you're just getting access to their list and it's an upfront fee, I think that's a situation that it's best to avoid. But if you have a financial broker who is legitimate, experienced, and can offer high value add, yeah, definitely worth considering, especially if you're new to business buying and don't have a lot of experience with lenders. One final point on using a financial broker: if you have lenders, you're the borrower, and the financial broker is between you, brokers typically work in hard asset lending, like real estate and fixed assets. It's less common to find financial brokers dealing in cash flow loans. It's not that they can't source a cash flow loan for you, but it's typically part of a larger package that's dominated by, fixed asset loans. I don't come across many specialists who are highly active in just cash flow lending, at least not in the SMB space. So that's important to keep in mind. In this last section, I want to talk about understanding lender documents. EOI, IOI, TSCL. There's a lot of terms floating around. Let's get to the bottom of them. EOI stands for expression of interest. IOI stands for indication of interest. And I would say both of these together are the initial interest lender documents. And lenders use just one or the other. They don't use both. There are only slight differences between them. Some people say there are no difference. They are quite similar. To me, there's a bit of a difference, so I'll express that in this presentation. But yeah, there's a lot of ambiguity out there in terms of the EOI and the IOI. Let's go through them, though. The EOI is the initial expression of interest. It's sent by a lender to a potential borrower who wants to borrow money to buy a business. And it serves as a starting point in the relationship. It lacks details. It's exploratory. It's used very early in the process. And it expresses the lender's general interest in the deal, outlines basic terms, loan amount, term, etc. It's not legally binding. I always kind of visualize it this way. I don't think this deal has made the lender's deal funnel quite yet. They are expressing some interest, but we haven't quite got into their deal funnel. Maybe that happens at the IOI level, the indication of interest. What's that all about? Well, again, it's sent by a lender to a potential borrower who's trying to borrow money to buy a business. It's slightly more detailed than an EOI, and I think it indicates a lender's willingness to proceed. More terms are outlined, the length of the term, the amount, etc. More is provided on the lending criteria. I'd say the deal is now part of the lender's funnel. Of course, it's still not legally binding. It's still a very preliminary indication of interest. Next, the term sheet. What's that all about? A term sheet, again, sent by a lender to a potential borrower who wants to borrow money to buy a business. It outlines the detailed terms of the loan. This time it's the full Monty. It includes the amount, the rate, the interest, covenants, collateral, and a whole lot more. It also outlines under what conditions the lender will lend. A term sheet is sometimes required by a seller to grant us exclusivity in the LOI. When we prepare an LOI, we're going to ask for 60 or 75 or 90 days of exclusivity to put the deal together. The seller, before they will grant, say, a 90-day exclusivity period to us, want to be sure that we had the funding in place. So they say, we'll sign the LOI giving you exclusivity, but I need to see a term sheet first before I'm going to sign off. That's not every seller, but some sellers do take that position. But these are the full terms presented pending due diligence. The term sheet is also not legally binding because the due diligence hasn't been done yet. Certain parts of it might be legally binding, like confidentiality, governing law, etc., but largely not legally binding. CL stands for the commitment letter. It's also sent by a lender to a potential borrower who wants to use the money to buy a business. This time it's a legally binding commitment to fund, obviously really important. And it's covered in detail in our video on finalizing the terms, so you'll get the full coverage in that video. Just to wrap up, success in business buying is a three-legged stool in my view. It's about finding deals, finding money, and improving the business once we own it. And if we can master those three, we're going to have a very successful career as a business buyer. Finding money when it comes to DIY business buying, it is our major preoccupation. It's our grand obsession. It's the most important skill to cultivate, in my opinion. So we make it a high priority. I think you should too, because at the end of the day, if you can find money, you can close deals. So let's get busy on that part. Next up is going to be our letter of intent. Let's get after it. This is the Do-It-Yourself Guide to Business Buying. And today we've been talking about finding the money because we want to learn and grow as we go. Thanks for watching. We'll see you next time.